It's pretty bright. Hello, hello. We are live. Can you hear me? Let's chat. Let's chat. It's been a while. It's been a little minute. Going live. We are here. I see a few people here. Welcome. Welcome, welcome. I don't have like a crazy itinerary today. I just want to catch up on a few things. I think last stream we had was a little bit over a month ago. I spoke a little bit on probably what was let's see. Spoke a little bit probably on VIX and correlation of VIX as well. Yep. At that point, we were just now trending down, and also we're looking at some sector positioning and like. Also, I spoke a little bit about LNG, liquefied natural gas, what oil did, right? Because that was the scenario, at least at that moment, with tons and tons of question marks as to like, is this war going to continue going? Are we going to get some kind of bereavement? Like, as well as the other concern of like, are we just gonna just fall over into oblivion and like nothing, you know? And I've also spent a good deal of time just thinking through things, ruminating, just trying to be, you know, within thought, and like within deep thought as to like what's actually happening here in the markets, like what is actually going on. And I think I've kind of pieced together a bit of the narrative. Again, if you know me, if you know how I've kind of put the markets together, I think a lot of times I place things together with the point of view of, you know, I have a bit of fanfare, I guess you could say, for the narrative, right? For the story that's being told, the story that society is, you know, that wants to be a part of this story as well. And I mean the stock market, like literally, like as well as a fundamentalist, someone who understands, you know, what is BS potentially, and what is, you know, maybe the next. I don't like this glare on my glasses, but what is potentially maybe something awesome to come with it. So like so basically my understanding of what happened since our last call, the last live stream into now is we stepped into a world of uncertainty, right? We stepped into this battle with Iran. Supply chains got disrupted. And there's definitely a trade there if you had that, right? Supply chains got disrupted, whether it was chemicals in the instance of it being needed now for our prime food and planting season. So companies like Dow, I want to say SLB as well. These chemical companies saw a huge uptick in value because their existing inventories are way more valuable than what they were just the month prior. As well as inversely, right? You could go long oil, right? You could have, just like in that example, I think I long Oxy and has been long Oxy, as it was a part of my original like top of the year thesis, that I really liked, and I kind of that I built out in the Integral Holdings paperwork that I wanted to bring through. Right, this thesis point has names like Micron, Amazon, GFS, Ondas, Bloom Energy, Caterpillar, Nova Nordisk. There's tons more in this report, but like you'll see, right? Like math getting done in terms of valuation, right? So I do definitely enjoy a good valuation story, and a bit of fundamental approach as well. Names like ASML as well, right? That semiconductor infrastructure was a major piece of it. I'm not sure when I updated this piece, but from then until now, out of the 14 names on this list, I believe only 2 are negative on the year. And some of the highs are Bloom Energy is probably up well over 100% on the positioning there. And GFS, I believe, up somewhere closer to like 70% as well in appreciation. That's not directly one-to-one in terms of what my book is, simply because have a diversified strategy where I'm using equities alongside options to be able to eke out as much as possible in that case. But yeah, I mean, Caterpillar's done monstrous stuff. I think it's this Friday it closed at like 8:30 or something like that. Micron as well. Like we're fighting up that $500 line with a ton of open interest in there. FCX as well. FCX got hit over the head recently with their last earnings, but overall, I still think the company's strong and positioned pretty well here for copper breakout, and we'll get into that as well in today's stream. Copper breakout and metals breakout, and how all that's going to be used for AI infrastructure and beyond. But some of these thesis points are maybe taking a little bit longer than I expected originally to catch steam because of the intervention of what was the Iran war and scenario, right? So there was trades in between there. There was, you could have short airlines because, jet fuel was astoundingly high, right? You could have longed LNG with like companies like VG and Venture Global and those names as well. You could have doubled down and shorted private credit. You could have hit financials. You could have hit a lot of things, really. And it comes down to your balance and your understanding to know that the current backdrop, my fault, is the way it is, and also at the drop of a hat, it can flip entirely, because what put us into that space, what put us into this negative territory where oil is $5 a gallon, and shipping costs and fertilizer and all the other if this then that chain events, could step in, and out of nowhere what was a thing can become a non-factor very quickly. at least in the perception of the eyes of a market, right? Because again, the market's very forward looking, and the way that they're perceiving things are, it's terrible, it's bad, we don't have negotiations, we don't have any form of what the heck next, that uncertainty, that high level of uncertainty. And then once you start to price in, oh, they're having negotiations, oh, they're actually talking to the government, they're not just running into landmines. Ah, I see what's happening here, right? Some type, and like, mind you, it doesn't have to be a solved conflict. It could be ongoing, right? Because think about it like this. To my understanding, I don't think the Russia-Ukraine war is done yet. That thing's still been going on since 2022. But the market didn't care about it anymore after, realistically, like what, 3-4 months back in 2022. Because what the heck extreme left field not accounted for event became the, oh, that's a very high possibility, let's bake it in, let's make sure the market knows what this is, understand what this is, you can move on from there. But it has to be baked in. Similarly said with NVIDIA, right? NVIDIA was this, and it still is, mind you, right? This darling of a company. Oh, all they did before was make GPUs for gaming kids and people that wanted to play video games. And then all of a sudden there becomes a huge use case for their chips that actually ends up being AI. And then companies like OpenAI, companies like Gemini, or products like Gemini in this case, because Gemini is a Google product, but I hope you get the premise. Claude, Anthropic, and Grok, and XAI, all these things come out, and everybody's willing to throw money at it now. And all of a sudden, it's the most important thing. And then what? The company that's enabling the ability for these chatbots to spit out 10 paragraphs of amazingness or slop, depending on how you feel, you know what I mean? It all of a sudden becomes the value mechanism, right? And now NVIDIA is a $4 trillion company, and they're the ones that's enabled this whole scenario up until now, right? And as it's gone on, right, where NVIDIA doubled and then tripled and then did all that, right? It was like, oh, they're the best thing, yeah. Price should go up. Oh, earnings come out. Price should go up. Beat early expectations again. Price should go up. Price should go up, right? Right? Until it happens so many times that the market becomes numb to it. Oh, yeah, they'll probably beat. Yeah, they'll beat their earnings. Yeah, maybe NVIDIA will be a $10 trillion company at the end of the decade. Yeah, maybe. Who knows? Right? They got numb to it. Because at that point, it's become the standard. Of course, NVIDIA should beat earnings. How dare they not? They're the AI is everything, right? And then because of that, reactions that we would generally see are muted. NVIDIA jumps 4% post earnings. Okay, cool. By the time the next day opens up, it's only plus 150 basis. It's only 1.5% up, or maybe it's down. Right? So the market's always going to continue to look deeper and a little bit further in expectations, and they want to be able to pull those points out. And the same thing happened recently with this war scenario, right? The news got so bad, everybody was super hedged, everybody was positioned almost perfectly. The assets just couldn't really fall the way that they didn't get the full cleansing in a way that would happen with a larger financial crisis event potentially. We couldn't quite get it. And then we just kind of jab lower. And then also you have a president. The United States of America has a president that does this thing, right? Where he gauges his success roughly off of how well the stock market is doing itself. And because of that, he's very subconscious of that. He makes sure that they make sure that anything that is said is for the market, right? So if I like in this example, I have a sure visualization of what Trump does. I posted. Cool. Bad news. The post is price, by the way. The price of the S&P, the price of Qs, the price of any asset, risk on asset at this point, right? Trump does this thing where he buys himself time, right? And he buys himself time by moving price. Moving price. This is price. Right? So any bad news that comes into play, tariffs, right? Higher levels of inflation, CPI, things of that nature, right? This war scenario with Iran, right? Other potential geopolitical issues, maybe even. We didn't even get into the fact about how Iran wanted to start using, or it probably did actually, start using yuan to transact and actually allow people through the Strait of Hormuz, right? But what happened? What he does with this thing is he knows that his voice is powerful, for sure, and that's one thing he knows. That the markets, they lean to hear what he's trying to say. Price does this because something's happening. It's going down. And all Trump does is he comes in with a tweet, with a Truth Social, and pushes it back up. And just ever so lightly pushes it back up, right? For the time being. It doesn't actually change anything fundamentally. It doesn't, most times than not, it doesn't actually have any concreteness to it. He'll tweet something at 7:25 p.m. and then completely reverse his thoughts at 7:30 and retweet another thing. But the point is the reaction to what's being said and what's happening with price, right? So he'll say something just to push price up. Push price up. What does that do? That creates price into a zone where it just stays. Or it goes down. Oh, push back up. It went down. Oh, talk about it again. Oh. Let's say something. Say something. Okay, cool. Price runs away in a sense, right? As opposed to if he didn't do it. If he didn't come out and tweet as often as he did, or come and say and host all these press conferences and have something to say there and do all those things, honestly, price would just continuously trickle lower or even drop lower dramatically because there's nobody there intervening with price. All we know is there's a war going on. Previous presidents will have said something, sure, but they're not saying something at the clip that he is saying something, right? So in a regular scenario where price would have just, we're just going to go about 10% lower, maybe, a low 12, nothing crazy. We're not going to use the R word or anything, but we'll call it a pullback. We'll call it a, we'll just call it a pullback, right? But instead, what Trump does in that scenario is, as price does recede and attempts to do something of a 10% pullback, it'll fall 2, Trump says something. It'll fall another 1, Trump says something. Falls another 3, Trump says something. So then the net ends up being minus 6%. Instead of the full cleansing, the full bleed out of a minus 10, minus 12%. That would generally happen when you don't have the backstop of a president that wants to be front and center, right? And front and center in the way of controlling things, as especially seeming the fact that he is gauging price as his actual scorecard. Price of indexes, price of equities is his scorecard. That's it. That's quite literally it. And all the other things that are being done in between, yeah, sure. He wants, maybe he wants to make sure that, free trade isn't getting ran over, and because of that, tariffs have to come into play, or make America great, or all the other in between stuff. He's not actually he don't actually care about that. He don't. But um, it's our job to try and navigate around that. And I'm not here to say it's super easy, but it's something that you could either try to completely steer clear from, or you can intrinsically save yourself from the headache by buying more duration, by finding and expressing your ideas outside of that world that is directly connected to that, as well as being more knowledgeable in everything across the whole basis to be able to do that. But yeah, so I just released a new Substack as well. I wanted to go ahead and share with you guys like what I put together on the Substack, because honestly, where are we at with it? I just released a new Substack called Invisible Yield, and it's what I'm talking about. I was reading some of this Substack. Oh yeah, sick. That's what's up, Joe. Hey Eli. I don't know if you're still here, but what's up, Eli? And this is for the investment side of things, right? This isn't for really something that's going to apply to traders or people who are looking to trade into something. But the invisible yield, the idea of that is, you buy stocks and you want to buy it for the dividend, maybe, right? You want to buy cash flowing names and they give you a cool 6% or a 4% type of scenario, or even better. But there's something else that I think a lot of the world aren't accounting for, aren't really looking into, and it's buybacks, corporate buybacks. And in this article, I'm not going to read the whole thing. I would actually would prefer if you went to read it. But in this article, it kind of goes into my concept or my idea of what I call invisible yield, which is when companies go out to the public market and buy back their shares from the public market, and then they kind of just retire those shares in a way. So it shrinks the total denominator. This is the real paragraph right here that explains it. The mechanics. When a company repurchases its own shares on the open market, those shares are in a way retired. So the total denominator of the shares outstanding shrinks. And as the denominator contracts, every remaining share of ownership is a larger percentage of ownership of that firm, of that company's earnings, of that company's cash flows, of that company's net assets, right? You didn't do a single thing because the company did it themselves. You didn't reinvest the dividend. You just simply held the shares that you owned and the percentage of the company that you owned, and it grew, right? And it's invisible because it's not a dividend. They didn't give you that cash to you. But in a way, you own more of the company than you did prior. That value of your 100 shares, the value of your 5 shares has gained the intrinsic value because of that, right? The same way how, and I gave an example of same way how a low population PSA 10 graded a Neo Destiny Dark Gengar, right? Which is this Pokemon card here, is valuable, right? It's because there's not that many PSA 10 graded cards from this early 2000s, late 90s version of this card, right? And if it's graded at a 10 by PSA and other firms that do the overall grading of a card, right? It in a way makes it rare. And to my understanding, a PSA 10 graded version of this card is somewhere north of 18 grand. And we're talking about Pokemon cards here, guys. And it's simply because there aren't that many PSA 10 graded Dark Gengars from Neo Destiny series, right? Because it's an older series. A lot of them got damaged, right? Like even in like the ones on listed here for like $200, right? Like these cards exist, but look at how it's damaged, right? They got little signs. These at the end of the day, these are kids games. Like all in all, end of the day, it's a kid's game. And if you were trying to tell me at 7 years old that I need to take care of my Pokemon cards more, I'm like, yeah, sure. What? No, what? Like, I put them in a sleeve. Now what? Like, the same thing with a vintage car. Same thing with a 993 Porsche right now. Right? Like, of course, it's valuable in the sense, right? But is it running? Was it maintained well? Right? And now that there's so much less of them, or so less of them, the value of a running one is even more higher, right? Like, I think I'm seeing Lamborghini SVs try and sell for like 900,000. 900,000. Lamborghini Aventador SVs. And that's a car from like, what, 2016 or something like that? And this is where we kind of like just talk about like life stuff in general and the pricing of assets in general. Because the ability to price assets and understand what's fluff and what's like foolishness is also in our real life stuff. It's also in a Lamborghini Aventador Super Veloce, right? It's also in a Pokemon card. It's also it's a natural human phenomenon. That's what it is. It's not something that's super unique to the stock market per se. It's unique to a market in general and the way that things are priced, period. The same thing happens for houses. Same thing happens for anything. It's the supply and the demand. Right? So if I come on to try and check this tab, DuPont registry, maybe. Let's see what the SVs are looking like. SV Roadster, maybe. Okay, they're coming in at like about 800 then. This white one, this SV, 800. This one right here, 750. Probably has a little bit more miles on it, maybe. 6,200 miles. Oh, no, not even. It's just priced. Right. But then also you look and you see what you say, okay, you're saying DuPont registry only has, what is this, 5 SVs for sale? What? And they're all relatively low miles? 2,000 miles, 7,000 miles, 7,000, 8,000 miles. No wonder why it's 700, 800 grand when sticker on this thing was like 280 or something like that. Right? Because this car is insane now. The amount of the supply has gone through all the stages. It's gone through, the 10 or 12% of these that got wrecked, right? Cool. Now that's completely gone. Nobody wants those with a lemon title. What are like buying a $250,000 car with a lemon title? Okay, that's that. That increases the value of the existing ones that are running and have decent mileage on them, right? It's all there. So your ability to price assets and understand where the values are because of the different market changes, because of what it could be and what it can be, is a completely different scenario. I think back in 2021 or something, SF90, what was it? Who said? 21 Savage said SF90 costs an M. Dump this Glock like Ye did Kim, right? That he's talking about the Ferrari SF90. Let's take a look at those. And he's saying it cost him, an M. And I remember back then, post-COVID, 2021 range, SF90s were definitely going for like 900K. Like plus. Now look at him. Look at how much, look at him. 550, 530 for the Spider, 560 for this Spider, a blue one, right? And these aren't like amazing specs of a SF90, but like they're good. Like this one's an amazing spec. Dang, no image? I thought I just clicked on with the image. That blue is beautiful on that one. Right? This looks like this is a base Ferrari SF90. These SF90 Spiders were going for monster numbers. They were going for like 999, 999. And now look at them. They got chopped in half because the demand went down. They produced more as the years went on. Right? It's just not as the demand for them has gone down. It's not the it car right now, at least. Who's this? But here's the thing. Who's to say that it can't become the it car again? You know? Right now you could buy a 2024 SF90 for just over $500,000 and shoo, you ride it for a little bit, don't put too much miles on it. Maybe by 2032, this car is worth an M again. That's just how price works. So it's your job to try to figure out what are these moving events? What are these events that can create price momentum and change and things of that nature, right? Everything was expensive in 2021, 2022. Hyperinflation. That's the central bank's fault. Why everything was super expensive. Because we had to print. The printer went burr to be able to get us out of the COVID scenario. But let's step a little bit further into some more market-specific research and see what you guys are interested in. So I think something that I wanted to kind of talk about as well was a fundamental approach on a few things. These are just all the research you can get from, was it this one? No, this is back in March. I went back too far. All right, CTAs went max short, everything fell. Credit default swaps continued to rise. Now they're falling. Where is it? This report, no. This report. CTAs, right? So commodity trend advisors have almost sold 55 billion in equities at the beginning of the month, putting them short. They're putting them currently short 18.41 billion in equities, right? They were short in this case. They sold a lot. They sold a ton, and even with all this selling, the index couldn't get more and like more like true selling. And that was something of super annoyance. And then we look at, no way, man. No, that's newer stuff. Where did I put it? Did I put it in market updates maybe? No, I look at pension flows because it's really where a lot of money moves at once. So when money moves, I like to watch it to see what happens, and see how it can actually affect in the market. But why am I not finding? It's like an image that looks like this almost, because I get it from Goldman's research deck. The cohort has been focused. CTA sold almost 55 billion. But the good news is almost over. The reduction in pressure is catalyzed at elevated vol levels. So unlikely for, there it is, to the upside, where we estimate CTAs will have to buy almost 86 billion in equities over the next month if we do see a sustained rally. Right? It's in the 99 percentile of 1 year lookbacks on CTA flow projections. Look at this. Beautiful. And the last time they bought a bunch, post what? That was post July, July. Okay, so that's July. This is this year. This is the beginning 2021. So July 2024. This looks like this is tariffs. This is tariffs right here, right? So think about it like this. We went from them being max short, selling over 55 billion, and they're saying that within the next month, they're going to have to come back and buy 86 billion of it back, right? Why do they have to do that? Well, mostly because they're systematic, right? They buy lows, they sell highs. They're very in and out in these funds, and they're most of the time they're calculated on price, calculated on vol measures, like calculated on numerical decisions. They're not deciding like, I think I should buy here. Oh, it's overvalued here. I'm going to sell. Oh, I think, or they're almost entirely numerically based in the decisioning. And when there's a lot of money being placed in the decisioning, right? And I also mentioned it here as well. I read through that or listened to that through Stanley Druckenmiller's one of his interviews, where he speaks about how, being in the game like for over 35 years and using fund flows to be able to try to see where money is moving, where things can be positioned, the transition of time from when he started in his game into how things have gotten systematic. He at that moment was saying that he was struggling to try to like see where some edges or see where certain things can be perceived and increased in value because of this, because of systematic flows and how they come in and just sell off and then come in and buy back up. And he's like trying to find like where he can really hit his bat at, right? Where is he going to really hit and swing for his bat? And that was another piece that I shared with here within the Integral Vote for the members to be able to read through, to watch this video to get an understanding of like build some contextual notes and evidence from Stanley Druckenmiller, one of the greatest money managers of all time, back in 2018. Right? So you can add the context of this is 2018. This is how he feels about certain things in 2018. Wow. Oh, that means, oh, wow. Okay. And guess what? We get to have the hindsight. He didn't have the hindsight when he said that. We got 8 years of hindsight to look back on and think about what he says in here. And also a lot of things that he says in this video proceed to come true. Things like how Kevin Warsh was potentially going to be the Fed president. And now look at where we are. Kevin Warsh is online, basically next man up to be the next Fed president. Talks about the Greenspan bill and what's going on with debt. And and then how debt's maturing, and now we have to figure out what's happening with the debt in this scenario, and we're still trying to figure that out how many years later. But the debt's ballooned dramatically since 2018 as well, you know? But to get back to this research part of the systematic funds I was mentioning, they came through, they were short. Then they said over the next month they got to buy 86 billion back, right? They're talking about there's going to be a potential flat tape, like up tape. There's going to be a ton of buyers across the world, 172 billion, but in the US, about 85 to the 86 estimate that we have. That piece of evidence came through March 26. Now let's take a look at. Oh snap! Yeah, my bad, Cody. I am live. We're talking systematic funds and how that made a huge difference. Let's just check QQQs, right? So we said, so we showed back in March of 2020, March 26, the CTA funds were short postured, and they've sold a ton of equities. Oh my gosh, I'm trying to get the image on here. They were short postured leading into this. This is March of 2020 or March 23rd, about them being short postured, basically the bottom, or close-ish to the bottom, I should say, really. This day right here, I wish I could like change a specific calendar, specific candle, or maybe I can. Highlighter? What does that do? Okay, that's nowhere near. Oh. So we said March 23rd, they were dumb short. Dumb short, 70 something billion. They net sold 73 billion of global assets, 137 billion over that last month, right? Then if we were to then look at what developed over time, CTA is saying that they're going to buy 86 billion over the next month by on March 26. They said that. March 26, that's this day right here. Cool. So we got this piece right here. We could do that on it. Let's like do that. Right? They said they're gonna buy that. They're gonna buy it back up. That's the bereavement. That's the break right there. We got a backdrop of a massive group of buyers that are willing to come back in. The systematic flows are willing to come back in to try and help bring this higher. Oh, say less. Right? And then as the whole thing is going on, I'm seeing, okay, cool. And then out of nowhere, we get confirmation of, oh, we're going to have some talks with the government of Iran to try and figure out this war thing. Oh, so we got the backdrop of a sentiment shifting, right? It wasn't a solution. It wasn't a, okay, war's done, da-da-da. But it was a sentiment shift where global supply chains that continue to break down lower and lower were now recognized to potentially see that this may be the end. Some type of floor may be getting hammered in here. And we have the buyers here to backdrop it and help with the tailwind to push us into new, which is what we see. Right? They come in, They said that they were already short because they've sold so much already. And then out of nowhere, systematic funds say, yeah, I think it's about time. Let's buy some more. Right? Then we got Goldman's traders, their CTA desk coming back that they're no longer short. This is April 19th. They come in and they say, hey, what's up? What's going on? Globally, they're no longer short. This is the update of it, of that graph. Right? And you get to literally see how CTAs and these other money managers move so much of the world, of the assets that we know. And there's a lot of cues and a lot of details that are within these data points that we we have to kind of look at. We have to respect to some regard because our accounts aren't moving assets like such. That was literally them telling us, hey, bottom is in. At least short-term bottom. Right? So with that being said, I continue to read through these things and I see what's going on. Now, mind you, I do understand that this is a very single sector driven kind of scenario right now, seeming that it's really all of what seems to be completely ran by semiconductors and the AI driven narrative as well. So let me see. Where is this at? See? The downtrend in the credit default swaps, we peaked around that like end of March. Mm-hmm. We saw similar action within energy stocks. 14 consecutive weeks, like it has not been seen. That level of like complete up. And now we could say that something similar has been the same with the semiconductors, right? The is it in here maybe? The semiconductors are starting to have some there it is. Here it is. Got it. The SOX, the Philadelphia Semiconductor Index, the super cycle is in motion. The SOX is now higher for 17 consecutive sessions, the longest streak ever, period. And it added 2.4 trillion to the market cap in general. You're seeing historic runs on companies. Credo Technology, 95%. MXL, 92%. Astria Labs, 78%. Marvell Technology, 65%. Like every single semiconductor that company that you can think of has gone up dramatically because of this, right? And they're the leading sector that's pushed what you just saw with the Qs highs. They're the main ones doing that. And you can see that right here. Here. Look at the up down. Every other sector has led in the downside except information technology, which includes all the semiconductors. Right? And now what that tells me in a way is like, and trust me, I love the AI narrative in the semiconductor space, right? Been able to bank on Intel, bank on ARM as of late as well, even bank on Micron. I think I did 96% this past week on Micron. I even did a little magic on NVIDIA, and I haven't traded NVIDIA in a while. What else? Himex, another semiconductor name, but a small cap company. Like there's tons and tons of opportunity here in the space. But now that we're up so much and we're a little stretched, I still believe in the narrative long term. But at least in my positions over the next month or so, I'm a bit more timid to be max positioned in semiconductors compared to maybe energy, right? Maybe energy can catch a bid here, or even financials, or even materials, because they kind of, go hand in hand. Like I feel like in a way, hand in hand, energies, materials, and industrials can kind of go together in some ways. And even I could even throw in utilities potentially. That they kind of are all in the same space, but they have so many subsectors in each one that they are most certainly still separate spaces, right? But the reason why I say that is because, you know, if we start with materials, the price of materials, it definitely leads into industrials and utilities, right? Talking energies, companies, companies that provide like Duke Energy, Con Ed, things of that nature. And then there are also energy companies as well. We're not talking about offshore fracking or specifically that, but although they are energy as well, but there's a subsector of energy that is utilities. There's also a subsector of of um, of industrials that I feel can also be utilities, right? Um, and that's something super important to keep in mind, right? Especially as we swing from one side of sentiment, where we were lightly positioned with the Z score, into being immediately stretched, according to Goldman's research here. So yeah. Not only that, but then we see the AI baskets and what's happening, right? It seems like all these baskets have taken off. The optical networking part, we're talking about AAOI, companies like that, companies like Amcor that do packaging work. I haven't checked Amcor in a while, actually. Hold on. AMKR, where are they at? Jeez! Oh my gosh! Oh my gosh! Listen, if you follow the live stream and you just come on the live stream and we just talk about things, you will know that I built this trade for Amcor late 2025. And look at it now. Jeez Louise. Wow. Like, I don't know what else to say about stuff like this other than wow. It hit all the price targets that we had lined up for 45. Okay, fine, cool. But it just blew everything else out the water entirely. Kind of the same stuff with ARM, right? ARM is a recent trade that I've developed and built out. And I built it out with the premise of, okay, break the 170. 170 is the buy, like 166 roughly. We could push into 180, 190 and have a high mega price target of 200 and see what happens there. And that just blew it out the market as well. Right. And like, I'm just like so reluctant, like MRVL, companies like these guys, like I was trading them back down here at 70s. Like how can I bring myself to like I do have positions up here, like with these entry points roughly up here, but like even just sitting here looking at this from a zoomed out point of view, I don't even want to own this like at that price point as much as I did prior. I need to try and find some better risk reward, because right now to me this looks like all risk. At any moment we could come back down to this 130, 100 range if there's a slowdown in capex, right? And we got earnings. You got earnings coming in. Earnings coming in this week. I think Wednesday after market close is like where like most of the Mag 7 reports, you got Google, I think Meta, and Amazon. And I think what they're gonna, if I'm being honest with you, if I had to bet, what they're gonna say is we're spending more on capex, but we're concerned about energy. We're concerned about grid. We're concerned about the ability to actually have to actually host the servers that we have and what we want to serve, because we don't have the energy capacity to do such. Right? And then this is where I start to get to building. And I'm looking at what could potentially be that. What could potentially, start to put those things together. And I'll share with you here now. Late last week, I started seeing names and sweeps into industrials and energy related names. If you go back to Discord real quick, right? You see JCI gets swept for a slightly in the money position, but yeah, or actually no, slightly just ever so slightly out the money position, right? And even they're super up right now. Like not much cleansing has gone into market positioning, even in the industrials. So look at the JCI chart over weeks, over the past 2 years, right? Like this market's really tough. You're gonna have to be super early on names to be able to get a good buy. Like you wanted to buy this, you had to buy this down 12%. You can't wait for a 20% pullback anymore. Like the market's just becoming so much more efficient, and it's all in a way like challenging you to just buy. And with that, like if you just believe in a thesis or believe in a story or have a fundamental reasoning as to the reason why you think you should own these assets, like you at this point you just have to buy, and you have to buy with duration, because you will blink and these names will be up 70% in your face and give you no pullback to get in. So my point of view, the way I'm viewing the markets right now is buy with the risk built in. Exactly, man. You know it. You know it. Big, massively huge on buy with duration. Because what we just spoke about with Trump. At least when I buy with duration on my options, there's some theta built into that premium in the contract, and it could defend me against a smack in the face when Trump wants to come in and talk about price, right? It could defend me in a way. At least that, right? So these zero DTEs and the same week stuff, it's beautiful. Trust me, do not get me wrong. And there's people that get it and they know how to do it. Like they truly know how to in and out, snipe, in and out. But my thesis doesn't like allow me to be right immediately because of my macro point of view. There's a lot of things that have to line up in certain cases, and it won't happen. Sometimes it doesn't happen immediately, right? And because of that, exactly, Catalina, right? The thesis was right. It just wasn't right now. Exactly that. And that's why I started building this strat. As you guys all know, if you're part of the Integral Vault, if you're not a part of the Integral Vault, please join, right? I'll share a link with you guys, but like it's really all a part of that entire system as to where that, listen, I am just a human. Like there's no way that I can know for a fact when this is going to happen, when that's going to do this, when. I don't know when. I just play the game of it's close enough, it can possibly occur, and I'm going to buy myself time to be able to sit into it and be able to grab that. So I just shared the link in the chat for the Integral Vault, where I share all my data. I share all the information basically it's like it's my dumping ground for my thoughts, honestly. I'll just be on the bus somewhere on the train just thinking about something or reading a report, and then I'll just like, oh wait, oh, hold on, let me write this up and kind of put some bullet points on this, or like what I'm taking from this, and I'll throw it into the Discord where the integral vote is, so that you guys can read it and get some analysis and probably some points of view there. Right, so this is where I marry the data. And a lot of times I talk about that often. I just marry the data and by duration and sit through it. And one thing that I found interesting was that this week I saw some interest in the metals again, right? People buying names like FCX, right? Off of the weakness from their earnings, something, right? The copper gold mining company, right? I've been trading this and buying spot equity value since like 45, 42 range. Just been holding that, the shares in that case, and then also trading a little bit of options around it as well. But we've come in a little bit here. There's a solid little 12% pullback, right? And the same thing I was telling you, the whole, wait for a 20% pullback and then buy, that premise isn't quite working as much anymore. And I can see that here because you can quite literally see that here, because boom, you can quite literally see that here. It's like they're already buying this thing up like nothing, and they bought mad duration 2027, 35. They're deep in the money. They want to buy these shares. They want to exercise this contract. That's what that tells me, at least, right? They're buying these. They put 3.6 on the line to buy and exercise the contracts. And in many other ways, right? I see a huge energy EOSC battery company, right? You see strikes like people putting a ton of money in Intel. That's a whole other narrative, but it's similar, because it all ends up coming back to AI in no sense. Energy, people are sweeping energy with some slight, some July duration, more PBR stuff with the Brazil focus to it. There's also SLB, right? That something's happening in that space. I'm not sure entirely, but even LGO, this smaller company that all of a sudden they want to come sweep it. It's a $1.50 stock. It's a buck stock, guys, right? With tons of volume, and they're sweeping. They just swept $250,000 into this name. That's a $1.25. Like something's and also you get to sense the theme. They are a mining company as well. This is a mineral-based business. Alongside the same time they're sweeping FCX, again, a mining company. Do not ignore metals, please. It seems like there's money going into it, and there's something here, right? And then they're also sweeping gold within that same rough time period. Somebody put a million change on just May 1st. Right? So you get to marry the data in the sense where you could see all this over the past little bit. There's some puts in between there as well. Yeah. And that could also probably just be some protection of somebody that's already massively long 10 million. They want to put a $1 million position on potentially hedging that bet as well. Right? But if you look at it, out of the, what is this? 3, 6, 9, 11 positions here, 9 of them are calls, and those 9 greatly outweigh in premium, greatly outweigh what they put in puts. So something to keep in mind here. Gold's moving, something's happening there. And then also, here's another thing too, from the flow desk on Friday, you knew that NVIDIA was going to go bonkers. From 934 million sweep. Okay. Interesting. Let's take a look. Then a few minutes later comes in a put. Okay. Maybe not. Boom. 1009, 40 million. 1009, 62 million. And same time, 1009, 100 million. That's a massive imbalance. And this is 0DT. What? Pardon me? Who the hell is putting 100 million? Doesn't matter if we're at 200 and the strike price is 162. 100 million into a name, period, is going to move the name. Period. Look at this. And then what does the video proceed to do? On the back of that news, a massive bonkers day, right? And this also goes back to what I was talking about, just getting in early. I bought in at this 202 level on the Wednesday and sat through the drawback that happened on Thursday, even though my managed risk here was saying 199, just because as we got to the end of the day, I was still seeing positive flow, and we just dipped down into it and we undercut, and then we bounced right back up. I was like, I don't mind the risk here. I don't mind the risk. And if tomorrow morning we open up and we continue to sell, guess what? I'll be out. But I'm going to hold my risk here because I like that. Right? And if we get down into a smaller time frame, surely it went vertical. Y'all are hilarious. Oh yeah, the Gex tool. Yep, I've been working on it. Been just trying to get it as accurate as possible. But I'm excited for you guys to have it as well. 2 days before I made the move, still got sick. Still got 150% out of it. That's awesome, Catalina. Happy you're able to grab some energy there. Tailwinds of AI narrative back in play helps stomach that risk. Exactly. Right? And then if we look at the timing here on the flow desk, you see that 934 call with the million comes in. Cool. Then by 1009, that's when they start putting in double-digit millions, 10 million plus. And if we look at just right here, and we kind of refine back to where price was, this is Friday from 934. Opening. At opening, they were basically buying this. At open, we bid up a little bit. Cool. A 1% move. We're back at entry. Cool. That ain't nothing crazy. Then by 1009, you see the buys. Look at this. By 1009, right here. And from that point on, you had all of 22 minutes to get right. 22 minutes to get right before that took off. You know what I mean? Like, oh, bet, my fault. It's so hard to flip between different things. Cool. This is what I was going to show. This is the video on the 1 minute chart price, and this is Friday's price. We saw that initial $1 million sweep around 934. The video pushed up about 1%, solid, nothing crazy, cool. You know what I mean? That million came in, and then immediately, shortly after, you saw another million come in on the put side. All right, it kind of washes that out. We're kind of back to zero on the overall pressure in terms of lift, right? Then we see by 1009, you see that other position step in, the 41 million at 1009 that gets followed up by a 62 million right after it at 1009. It's all right here. You don't see that in the price. Not yet. You don't see it in the price yet. And then even in that same minute, another 100 million comes in. So in 2 minutes, basically, or in a full minute, essentially, you get 100 million with a 28 days to expiry, and then you get another 100 million on the 0 day to expiry. And between that time period from the 1009 to when it really starts taking off, You got all 22 minutes to put your bits in order. We don't got time. I still work a full-time corporate role. I don't have time to be that timed into the market. So what do? I try to find these trends prior to. And I have to be okay with sitting in that risk prior to right here where we saw this grouping above like at the 200 level. I have to be able to be okay with that risk. And I knew that was going to happen with a 639,000 at the open interest there. That's a major resistance. No wonder why I danced at 200 all for the whole week and even last week. Because they're trying to get through that level of resistance. Then after that, it pops straight through 196 to 240, the next real challenge of open interest, right? 240 was like, whoa, hold on. We just got through this 640, this 640,000 open interest. And we could push through this 194. That ain't too crazy. But still, this 240, immediate resistance. And you can see it right here. Come on. You think I'm picking price targets out of out of a hat? The numbers are there. They're given to us in a way. And that's the boop, top of the day. Like when I said SPY to 625 today, and then it moves SPY 625 that same day. Or when I say car short, car top is in, car falls 50% in 2 days. Oh my god. Oh, it's just so funny. Yeah. That's so funny. But yeah. So I guess I just want to, maybe I'll wrap it up here a little bit, but no, for real, they do need to stop playing with me. But I want to talk about sentiment gauges, what I'm reading so far as well this weekend. Shared a ton of industry notes. I think something else came up recently as well. If I share, it's in updates. Yes. Secretary of Energy is directed to make purchase commitments and financial instruments to enable projects to expand domestic capability to manufacture and deploy grid infrastructure, supporting supply chains. The White House is essentially, the government's directly funding, contracting, and subsidizing domestic production of grid hardware, bypassing the normal procurement process. And that's the T. That's what I want to kind of drive home on that right now is that this memorandum for the Secretary of Energy that originally got issued January 20th, there's an update on it that came through just on the 20th of April. And it's basically asking for better grid infrastructure and asking for critical items to be done in a timely manner, right? So there's going to be pace to it. They want to reduce foreign supply dependence, insufficient capital investment, and they declared this as a national emergency. They've done this before, right? And that's kind of why, like this memo showing up again is kind of, bringing back to the forefront of my mind is like, all right, energy is important, right? Especially after them just messing up a ton of energy. I'm thinking, yeah, this is going to fast track investments. We're going to start to see the industrials take a bid. We're going to start to see more energy focused names catch a bid, right? Think of the Bloom Energy, think of EOSC, think of companies like Siemens, like the industrial companies that build out these data centers. especially in the sense now, right? Domestic-based companies, companies like ETN. I think I also saw a sweep on ETN as well. And ETN is just a ticker, sorry, but Eaton Corporation is the company, I believe. They manufacturing power, electronics, energy sufficient solutions, that kind of stuff. But they're very American based. That's what's giving them the edge, right? It's a recurring theme. If you watched my Q3 2025 video where I spoke about the importance of watching the U.S. government's like stakes on things, right? At that point, they owned 10% of Intel. Look at Intel's price. They're higher right now than they were in the dot-com bubble. Look at what happened in the critical mineral space. Companies like MP and USAR, they caught a bid. The bid sizzled, but there was a trade there for sure. Right? The bid sizzled, right? The names came in for sure, right? They're no longer at these elevated levels like an Intel currently, but there was a potential trade there. And stuff that you could have bought with some slight duration and hold for a week and 300%. There's an opportunity there to be carved out for sure. But that's got me thinking, right? If I tried to marry the data in a way, right? That's got me thinking companies like Google and Microsoft, they're going to come through and announce earnings this week. And then they're going to say, we're doing good, rah, we're doing good, but we still need more energy capacity. We need to be able to have more energy online so that we can actually run the data centers that we want. That's going to increase demand. Bloom Energy reports earnings Tuesday after close. I'm not expecting a good one, to be honest, but I think the market reaction will be good. But I don't think their earnings will be good per se. But I also don't know anything. So don't listen to me. Don't go bet on earnings. I personally find it much easier to just bet in the aftermaths of earnings than earnings itself, because there's so many variables with earnings, right? They can beat, they still fall. They can fall, they can have terrible earnings, but then they can still appreciate. They can have terrible earnings, appreciate in value, and then the CEO says one particular thing in the earnings call, and then they decrease it back. And it's like, where is the logic here? Like, what's actually like headache? This is confusing. And I tried to leave that alone. There's other people that have edge in that, and that's awesome. Salute to them. But another thing that's really important in this game is to know where your edge is and to trade your edge as opposed to someone else's. Jane Street posted $40 billion in profits because they know their edge. They step into a market, they manipulate it, they do what they want to do with it, and get up out of there. That's their edge. They own like most of the IBIT ETF now. They were doing that over in India until India markets kicked them out. But not many people know about that. You know what I mean? Not many people know about what Jane Street was doing in the Indian markets in the Nifty 50. Sorry, not Nifty 50. I think that's Nifty 50 is London's market, but I'm trying to remember what's India's. There's a ton of earnings happening this week, and all this, what makes me want to do is cut my portfolio in half. Get closer to cash than I've ever been. And also these sweeps, they have a slight less of an importance in gauging my positions because there's so many ways of going about it. People are probably hedging positions. People are probably, like they're like, for example, people are probably already long Bloom Energy, and they know that earnings are coming in and they don't know what's going to happen, but they're trying to protect their position. So they'll hedge it in a way and they'll go put on a nice put position, right? Not because that they're negatively sentiment based towards Bloom Energy, but because they're so long equity that they figure, I should put a hedge against it. I should be, a prudent capital manager and make sure that I protect my ass over something that I can't explain. Car got earnings on Wednesday. I'm still short them, trying to see what could happen there. Got Enphase. There may be something there with energy, excuse me. I think NXPI is a semiconductor name as well. Is it? Yeah, they're a semiconductor name. I bet you they're probably up through the roof. Oh, they're not up through the roof. Hold on. NXPI is up, don't get me wrong, but it's not up through the roof. Maybe there's something there. Put it down the watch list. Look at NXPI. It's up. Don't get me wrong. Over the past 3 weeks, it's up 25%. But it's not up 70 like we saw in Amcor. Or 90 something in on semiconductor, right? It's not that. It's still NXTI. Damn, what's the ticker? I already forgot the damn ticker. NXPI. Here we go. Sheesh. Right? Like, it's like, to me, this is a beautiful setup. This is almost all of my setups that I take. Previous high gets rejected. We build up momentum. We go back. We establish a new high, but then we come back into this. We retest into what we had as previous price. There's no new real discovery, but now this acts like the base. This acts like the median price, right? So basing occurs. Basing happens until price sentiment begins to shift. Then we have this ramp here that we get to build off of, and then we can base out of, and then we can potentially catch something. Okay, that's crazy, but hold on. If price momentum increase comes in, catch something like this, right? Where we could see the 240, 245, maybe it's the 250 that really needs to break, and then we can catch momentum over 250. Push that here, 250, 260 is the first PT, get a good trim there. 270, the next PT, get a great trim there. Then you can even fuck around. And then after that point, you're up so much because it's risk-free capital. You get to skip a whole 10 points and then say, all right, last PT will be 20 points higher. That's another 7% increase. Let's attack the all-time highs. Trade done. Like that's how quickly I build my trades. Right? And then I'm putting on the position, boom, put on the position, let it ride, set an alert on price as it moves past it, cool. Alert on price as it moves past it, got it. Set my managed risk here line just below entry, right? To give me some alert like, hey, check this, watch out, be careful. Right? Boom, boom, boom. And we move on with life. Set my alerts go off. Okay, I don't like it. Check the flow. Nothing comes in. I don't like it no more. Trim it. I'm out of it. And even if it goes against me, guess what? I probably still made money in the first, locking in the first price target at 260. Looks like the arm trade. Exactly. It's the same trade. I think the same trade every time almost, I feel. Data centers are getting shut down all over the U.S. because energy issues too. Lots of lobbying against environmental effects. Yep. Water pollution. Yep. Oh, that makes you think about this too. We can long water, right? Like the same way you can long oil and get a barrel delivered to your home You can't quite long water in the same way, but there's companies that uh that are part of the water ecosystem. Um, and I'll let me try and find some of those names as well. WTRG. Let's see. That's essential utilities. Hey, water utilities. Okay. Hey, water looks very valuable to me. Look at this. Wow. Overtime. Just beautiful. Okay. That's something interesting there. Maybe WTTR. I got to put these in my watch list to watch as well. This is oil and gas production, but it says select water solutions. I wonder what that really means. Select water solutions engages in the provision of water management and chemical solutions. It operates through the following business segments: water infrastructure, water services, and chemical technologies. The water infrastructure segment develops, builds, and operates permanent and semi-permanent infrastructure solution to support full life cycle water management, water treatment solutions. I mean, seems like a pure play water to me. I don't know why it's an oil and gas productions sector in TradingView though, but I'll let that ride, I guess. AWR, water utilities. Hey, yo, why does this look just like the rest of them? Look, price runs up, appreciates, creates a new high. It finishes out, it sizzles, it finds a base, it retraces back, creates a new high, and then does the same. This is quite literally the same setup, almost a torch setup in a way. But, you know, price in a way has come to this level as like a median or a mean. And that's where we find the basing. You find the basing at the mean, right? And then price wants to try and ramp up out of this. It's the same trade, y'all. The same trade. I could come through and draw the same levels. The break of the 80, cool. Maybe the break, maybe it's a 5-point increment from here at this point. Break of the 80, set the entry, vibes, be so early in the position. And then if I'm wrong, cool, I'm out. Manage risk here line probably needs to be at like 78, something like that. So I could just be like, all right, what's happening? What's going on? Let me reevaluate, set the alert, boom. We're there with that. 5-point increment, 85 becomes PT. 5-point increment on this with some good duration in the name. That's easily a 30% lock-in profits at the first level there at 30%. That's lovely to me. 90 at the second PT level. And then maybe we get a little feisty and try to target the 100 for the mega PT level, right? Now all this has to go ahead and get double confirmed by open interest potentially, but that's a trade. That's a built trade right there. Boom, just like that. In a matter of 45 seconds. Right? So now I need to watch to see what happens with that. And yeah, I gotta go look. The same trade. It's the same trade. Because, and you know why they're the same? Because the people trading him, they're still humans. At the end of the day, they're still humans. And then guess what? Now that it's systems as well, now that it's computers as well, guess what? Computers are going to do what they're told by humans. So it's going to become even more calculated, even more systematic, right? The discretionary people are going to run off their are going to generally run off their emotions if they're retail. If they're institutional discretionary, they're going to be a little bit less reserved with their emotions, but they're going to be more logically based, right? But even people like Druckenmiller got tied up in the 1998 dot-com bubble trying to go catch more upside because his emotions said so. You know? It's the same trade. So I need to clean up my active watch list. I think futures are lower today. Let's check. Yeah, we're lower. Oh, but barely. What, 6 basis points? That's nothing. Like, oh, we did drop a little lower earlier though, at the beginning of the session. Same thing with ES. Seems like Nasdaq is not putting in the quits for it to just come back and immediately eat that up. Like, oil is up about 190 basis points, so that's something. Metal's not really doing too hot though. It's not doing terrible, but it's not doing hot. Japanese equities, 57 basis points lower. Let's see. Bitcoin's kind of vibing sub 80. I mean, it's doing better, right? Like, it's ramping up. It hasn't really dealt with much craziness. It's doing better. What's the dollar doing? Dollar, has come off the 100 level. I completely forgot to check this. Wow. That's pretty good, though. At least it gives a little wind, little lift to risk-on assets as well. But yeah, I mean, I think that's it's a normal cycle. Yeah. It's a normal cycle, you know? But I think that's pretty much it for me this evening. I did also just recently release a Substack, as I mentioned prior, or in the beginning phases of so I'll share that link as well. That's the Substack link for you to go ahead and get a good read in. Try my best to be more and more consistent with my output to society, to the markets, to the world. Just try to be that person that I wanted to have in 2018, 2019 when trying to learn about the markets. You know, that's been my goal as of recent, for sure, as well. And figure out, the necessary steps to push this into a private capital hedge fund positioning. That's probably one of the goals, and that's the steps we're moving towards. But I'm building out a curriculum for like a boot camp as well that goes in depth, talks about these types of things over and over and over for members and people that want to take trading seriously and want to challenge themselves and put themselves in the next tier as well. But yeah, just know when you're out here trading, you're fighting against other people that live, breathe, and eat this stuff. The people that have mountains of books at their desk to continually go over and 4 more in the mail coming in. The people that take showers listening to podcasts on markets. The people that use their downtime to read more. The people that find their ways into crazy rooms that they're technically were never invited to. to figure out any form of edge, to figure out really and some form of understanding that the rest of society maybe isn't working, or open a third eye in a sense, right? So if you want to consistently win in this game, you have to also stay sharp within it. It's not learn today to have for forever and just whatever, but to add and compound on your knowledge as well, the same way hopefully your account is compounding. All right. So peace, guys. That's pretty much it for me. I hope you guys have a great rest of your Sunday evening. We will talk soon. Follow me. Follow me on Instagram. My name is just Nedrick. If you don't follow me already there, that's my Instagram. Do you explain how market order flow affect the immediate candles? Like how I explain those orders in the video chart? Oh, okay. Well, like a lot of times I do share those points. Yeah. I got you. I'll here to answer your questions real quick. Yeah, so I explain in real time most times. I'm like, hey, just like checking on these stuff, checking on like, hey, this looks interesting. This is really like lively. I think I mentioned that NVIDIA stuff like real time. I think other members of the WAP, please let me know. But I'm pretty sure I did at least real time. Where was it at? Here. Yeah, on Friday, I sent this out at 10:13 a.m. The orders came in at 10:09, and I'm like, someone trying to buy dumb shares at 162, right? Like, that's the other thing too. Like, in the event, I'm not necessarily there to explain it fully. I want to understand if there's an overall way to tell how order flow affects the candles. Well, yeah, of course. Is it measurable and trackable? Oh, like into that depth? Yeah. I mean, I don't think that's a no, but I do think there's a lot of math involved in that would also require lightning speed calculations and like stuff like that, you know? Yeah, I mean, you could definitely implement it within intraday trading. Usually, I think you'd have to mostly filter for options that are closer to expiry, right? So something that's expiring today, expiring tomorrow, kind of thing, to be able to get a gauge on that. But yeah. Do I explain order flow in the WAP? Yeah, for sure. I explain that all the time. It may not be real time, right? Like in that moment, specifically, oh, this order is doing this potentially to push it higher. But I'm explaining that all the time, right? Like on 0DTE stuff, or even, you know, like longer term positionings as well. There's a bunch of times there where I've built trades off them. It's just that they don't happen to, like I mentioned earlier, they don't happen to occur immediately, even though the thesis is correct. So I end up buying duration and just seeing what happens. Right? I go through open interest. I go through in much greater detail flow and like what happens. Think of it like this, Catalina. I'm gonna break it down real simple. Ready? Larger orders. Yes, it does affect the current day chart, but it affects it less than a Right. Exactly. Yeah. Cody's see, and Cody's an integral vote too. You know what I mean? He be giving out hella gems too. Um, but yeah, it's like the larger flow orders does affect the current day chart if it's an imbalance in calls to puts or in other ways, vice versa. But I think it's not going to affect it to maybe the way that you're thinking of, right? Like, it may not fly 4% in the day, and then their options are up 80% because of it. It may not do that. No. Well, what is really important is the recurring order. Oh, you saw them buy, like, finding the trend in the buyers. Oh, somebody bought gold today, then they came back and bought more again, and then they're continuing to buy calls, and they seem to. Here's a great example of that, actually. SGHC, a gambling company. Let's try and find it. SGHC. I tried to trade this back when they had a ton of accumulation back in late 2025, as you can see here over the right hand side. People buying $250,000 at $10. People buying like tons of market color flow, repeat activity in the April 10 strike, right? Tons of volume out of nowhere in an $11 stock, and that was like December. Well, you can't really see what I highlighted, but it was December of last year. Tons of bullish flow as well, and I'm like, okay, well, what's going on over there? Like, they continuously add the April 10s, right? Where open interest continued to stack to 100,000 open interest there. People were just sitting in those contracts. But guess what? Just a few weeks ago, we've passed April 17th, right? So that capital has essentially expired in a sense, right? And I even built strategies like, hey, like, there's a bunch of stuff going on with casinos and Hard Rock and this. I wonder if this has anything to do with SGHC sweepers and the April 1410s. I don't think that's the case, because none of those news points came out to help SGHC. So it didn't happen. That was just my hunch, my idea of like, what? Okay, I'm just thinking what could move this name, because SGHC is a casino name, right? Then they come back again. Remember SGHC? In December, they kept on adding more into the April. Then they came back and bought more into April, right? Like, something's happening here. Then more recently, another order, more sweeps, more people. Like, they repeated this buy over again. I'm like, you know what? All right, I think I want to take this buy. And at that point, the price didn't really move. The price was stuck between 10.50 and 11 something, right? It didn't really move too much. Then more recently in April, I'm seeing more people roll out their contracts. Boom. We're seeing people in the bid side hit the sell for their strike contracts, right? They're selling out of the May ones, and they're trying to roll into some more duration. Or sorry, the April ones. They're trying to roll into the April duration, right? So what ends up happening in that case is, you have a ton of selling that moves, right? They move a little bit closer into the money. And then at that point, that creates more buying, because the rolling part of it, the rolling aspect of it, is essentially them selling one contract to then take that capital, and then maybe even more, to then go put it into another contract, the same equity, the same underlying stock, but with a longer time frame and maybe a different strike price. Yeah, for sure. But the thing is, Catalina, those events don't happen every day. That's kind of the part as to where it becomes difficult. And just like Cody says, like the markets aren't that rational where that will happen every time. $100 million buy on NVIDIA is not a every other day thing. Just like how a $50 million buy on another stock is not an every other day thing. You know what I mean? So like those are instances when that happens. And because it's just so much buying, only one side takes over. Right. And that's why it's tough. Yeah, the market's tough. This thing is not, there's never a game, really. Market's tough. But the point being is that these order flows are cues to build your research on, to build your positioning on. They're not necessarily indicators to say buy now. Right? But sometimes they can be. Because there will be a buyer there that's aggressive enough that wants to be that aggressive and show their hand in a way. But they're not always there. That's the point. They're not always that aggressive. Because they'll move the market, as you see. And if you move the market too quickly, then you can't get more exposure. Right? That's like imagine somebody wanting to buy a building in New York, right? They want to buy a building in New York, right? Cool. Imagine if they went out and just explained to the world why this building is amazing. And that they should buy it. Yeah, for sure. No problem. Happy to stay. Answer questions. Right? All that does is attract attention from other wealthy individuals to say, well, shoot, he's right. Maybe they are into something. Maybe that building is attractive. And then now it's a whole bidding war of how to go buy this building. Because you've shared, you've uncovered, you showed your cards in the sense that, oh, you're no longer the only person that finds this thing valuable. So when hedge funds and when money managers and people who have money at high stature, they trickle into positions. They'll buy some today, buy another piece tomorrow, buy another, maybe hit a big buy on a Wednesday. Cool, right? But they're not insta buying, because their insta buying will push price 4%, 10% higher, and then they can't buy no more. And they want to accumulate more. So, yeah. Yeah, certain stuff could definitely be a false flag. For sure. It's not one-to-one, essentially, is what I'm saying. There's discretion within this. There's trading and order flow and sentiment is an art form. It's not exactly a one-to-one scenario. There again will be instances where it is one-to-one, very easy, but it's not always going to be that case. Not every shot you take on the basketball court is going to be a layup. Sometimes you're going to have to heave the half court. Do you watch Black Monday? I don't know what Black Monday is. Is that a TV show or something? I know what Black Monday is in the sense of the markets. It's a comedy series. Okay. No, I haven't seen it. Is it good? Should I be watching it? Dark comedy. What is it about? Chronicles the 31st anniversary of the stock market crash from 1987. Oh, wow, that's cool. And there's black people in it? Okay, maybe I should watch this. No, I've never watched it though. Regina Hall. Yo, is there mosquitoes in here? All right, y'all. That's enough. I just feel something on my leg. Yeah, maybe I will take a look at it. We'll see. But yeah. All right, y'all, fam. We'll talk again soon. Have an amazing Sunday. I gotta figure out dinner quick, and digest that and head to bed. Got a big week ahead of us. I hope you guys have a great one. Happy trading. Babe, is there mosquitoes in here? Peace. How do I end this again? Oh, it's up there.